Hello and welcome to this RJO Futures quick tip. This is Philip Strebel with RJO Futures in Chicago. In this quick video, this is going to be a video that pertains to if you're currently trading stocks or perhaps considering futures markets for diversification in your equity portfolio. This video is going to help bridge the gap between stocks and futures trading and answer some of the questions that you may have. RJO is a full-service futures trading firm that has been around over 100 years and have been advising clients as well as assisting those who would like to become involved in the futures industry. Now remember that futures and options trading does involve risk of loss, and it may not be suitable to all investors. Now looking at the stocks and transitioning into futures, you may ask yourself, what is a futures contract? Well, a futures is just that. It's a contract. It's a buy or sell of a specific commodity at a specific price for a specific date, and it's all on the future date. You may look at different commodities and different futures like gold, oil, corn, coffee, and cotton. Really, they're designed for someone to gain exposure to commodities. Now, what are futures? They're standardized quantity, quality, and delivery. They all have, again, specific prices, times, specific contract specifications, whether it's the size, like on gold, it's 100 ounces, on corn, it may be 5,000 bushels. And it's set for the buyers to agree or take delivery at that future date. Those commodities trade under specific contract months. Now also on the sellers, they're also going to agree to make delivery at specific contract months at a future date. Now one thing that is important is you do not need to take or make delivery today. Now looking at trading futures, the whole key to trading futures and the reason why most people trade them is leverage. And here's a quick example. With corn trading at $4 per bushel, one standardized corn futures contract equals 5,000 bushels. You take the $4 per bushel, times it by the 5,000 bushels, and that's going to give you $20,000. That's the total contract value of one standardized contract of corn. The margin requirement, which is the small amount of money that you need to put up, is the leverage that it's going to give you. So you're buying corn, you need to put up a margin requirement of $1,100 or approximately 7% deposit. When you buy corn at $4, if it rallies 6% to $4.24, you're going to see that particular profit, that 6%. When you sell corn futures at $4, you may take a 24-cent profit. If you take 24 cents times it by 5,000 bushels, it gives you a total profit of $1,200. Remember that futures trading does involve risk of loss. Now a couple key things that I want to discuss here that are some differences between futures and stocks that you might want to look at is the margin. That's the fourth bullet down. A deposit of 6 to 18% is pretty standard for the value of the underlying futures contract. This is where the leverage comes in. It's the small amount of money that you need to deposit in order to control that full contract value. If you look at stocks, if you purchase them on margin, a minimum deposit of 50% of the security value, which is oftentimes considered a loan with interest. So you could see that the leverage with the small amount of money that you do in futures, you're going to be able to control a greater amount oftentimes than you can with stocks. Another item that people look at when they're trading futures versus stocks is it's an easy way to buy and short with very simple positioning here. You would just execute an order to sell and you establish a short position. You execute an order to buy, you've established a long position. When you sell short on stocks, it requires you to borrow the stock if it's available, and you have to sell only when the price of the stock is rising. This is known as an uptick rule. So there are some differences. And then, but something that's most important is the risk of loss. On futures trading, due to the small percentage requirement that you have to deposit, that margin requirement, you can lose more than your initial investment. When it comes to stocks, the stock bought on margin is the maximum amount of loss here is just 100% when they're not margined. So you have different risk of loss on stocks versus futures. So you do want to remember that when you're trading futures that there's risk of loss and it may not be suitable for all investors. Please enjoy this quick tip from R.J.O'Brien, and again, this is Philip Strebel with RJO Futures in Chicago. Thank you.